to another edition of African Economy. I am your host, Wang Water. Now the top stories. Angola's debts reached an all-time high of 68.3% of GDP. AFDB commits $500 million to Ethiopia's $10 billion airports project. Namibia bids to join nuclear suppliers group as world's third largest uranium producer. Plus, South Africa to offer revised trade deal to the US after 30% tariff hit. The African Development Bank, AFDB, will provide up to $500 million to help finance a new airport in Ethiopia slated to become Africa's largest upon completion. State-owned Ethiopian Airlines has signed a design agreement for the four-runway facility to be built near Bisoftu, about 45 kilometers southeast of the capital, Addis Ababa. The airline will contribute 20% of the $10 billion project cost, with the remainder to be sourced from creditors. In a statement, the AFDB said its $500 million pledge, pending board approval, will serve as an anchor investment for what it's described as a transformational regional integration project. Angola's debt reached an all-time high of 68.3% of GDP in 2024, even with a slight projected dip to 67.7% in 2025. The country remains in a position where more than two-thirds of its GDP goes into servicing debt, the highest ratio in Africa. The chart also shows that Angola's debt service ratio has not been a steady climb, but rather a series of sharp spikes and drops. After years of moderate levels under 15% from 2009 to 2014, the figure more than tripled between 2014 and 2016, hitting 41.9% in 2016. The years since then have been earmarked by volatility, with multiple jumps above 50%. Debt service obligations across African countries in 2024 reveal sharp contrast in how different economies are managing the burden of repaying the public debt. Angola leads the continent with the highest debt service to GDP ratio at 68.25%, as earlier stated, followed closely by Ethiopia at 67.01%, underscoring the strain that debt repayments place on the economies. Remarkably, 5 of the top 10 countries with the highest ratios are in East Africa, signaling a regional concentration of debt pressure that could affect fiscal space for development spending. This trend is especially worrying considering the fiscal limitations many African countries face. For example, in economies like Ethiopia, high debt servicing eats into budget that could otherwise be allocated to infrastructure, education, or healthcare. It's like a household spending most of its income on loan repayments with little left for essentials. On the flip side, countries like Algeria, Zimbabwe, and Botswana sits at the bottom of the debt service to GDP chart, with Algeria at strikingly low 0.10%. While low debt servicing may suggest better fiscal balance, it's important to note that it doesn't necessarily equate to stronger economies. It could also affect limited borrowing or deferred obligations. Nonetheless, the range between Angola's 68% and Algeria's 0.1% reflect a stark divergence in how African countries are managing their debt landscapes. Most African countries have undeveloped statutory pension systems, according to report. This report also mentions that domestic pensions funds may drive capital markets development by diversifying across asset classes and investing over long periods. A substantial pension fund serves as an important pillar in a country's financial structure. Pension funds, by collecting resources from workers throughout considerable contributions to capital market, particularly in developing economies, many of which can be found in Africa. Pension funds are long-term investors that often invest in infrastructure projects, government bonds and private sector activities to boost economic activity. These investments have the potential to stimulate economic growth by creating jobs, expanding businesses, and developing infrastructure. Additionally, a well-developed pension system contributes to a more secure and less volatile financial climate, encouraging both domestic and foreign investment. With that said, here are the African countries with the best pension situation. Namibia ranks as the first with 100, and the pension fund. Namibia ranks first, I beg your pardon. Second is South Africa. Third is Mauritius. Fourth is Seychelles with 60, and Botswana followed. The sixth is Eswatini. Seventh is Morocco. Eighth is Lesotho. Nine is Nigeria, and last is Ghana. Imagine trying to run a hospital without a stable power supply or a school where children can study after dark. For millions of people in countries with less than 50.3% electricity access, this isn't just an inconvenience, it's a daily reality. The low access rate in nations like South Sudan and the Central African Republic are a stark reminder of the immense struggles many African nations face, often linked to conflicts and instability. Let's look at the chart. Now the numbers reveal the full scale of the challenge. 14 countries on the continent have less than 50% of the population with electricity, and 12 of those have less than 40% access. At the very bottom of the list, countries like South Sudan have a shockingly low access rate of just 5.40%, while Burundi stands at 11.60% and Chad at 12.00%. The history of electricity in Africa is a long one, with pioneers like South Africa leading the way. Driven by the mining industry, the town of Kimberley was one of the first cities in the southern hemisphere to get electric streetlight in 1882. Other nations also saw early localized power, with Lagos, Nigeria, providing electricity to the government house in 1896, and the palace of Emperor Yohannes IV in Ethiopia being lit by a diesel generator in the 1880s. Looking at today's data, a striking detail is the 100% club, where 6 countries like Algeria, Egypt, Mauritius, Morocco, Seychelles and Tunisia have completely electrified their populations. A clear pattern shows North African nations, 4 of the 6, and island countries dominating the list of most electrified nations. These achievements highlight a successful focus on infrastructure and stability in these regions. The data shows that with the right investment and policies, universal access is a very realistic goal for a country to achieve. However, a significant gap exists between the countries with full power and those still working to get there. Kenya has invited international development lenders to help finance a $2 billion expansion of Nairobi Jomo Kenyatta International Airport, just 9 months after cancelling a deal with India's Adani Group following the indictment of its founder in the United States. Facing rising public debt, and seeking alternative infrastructure financing options. The East African nations will also issue a we also issue a securitized fund worth 175 billion shillings next month for road construction, Transport Minister Davis Chiache told reporters. Chiache said the government had approached several development agencies, offering them the opportunity to finance the airport's project by leveraging JKIA's balance sheet. Agencies contacted include the Japan International Cooperation Agency, China Exim Bank, KfW, the European Investment Bank, and the African Development Bank, according to report. The planned expansion will include the construction of a second runway and a new terminal building. Once funding is secured, the government will then seek a contractor to execute the works. Shifting focus now to Namibia, Africa's largest uranium producer, is ramping up its nuclear ambition. Namibia has formally endorsed its bid to join the Nuclear Suppliers Group, the international body that sets rules for the export of nuclear technology and materials to prevent the use in weapons. The Ministry of International Relations and Trade will spearhead the application process and establish an interministerial committee to ensure compliance with the NSG guidelines, the cabinet said in a statement. As part of the effort, a Namibian delegation will reportedly lobby the International Atomic Energy Agency and the NSG chairperson on the sidelines of the IAEA General Conference in Vienna. Uranium, the primary fuel for nuclear reactors, is already among Namibia's top export. Output rose 59% in April from a year earlier, according to a Chamber of Mines and industry lobby group. According to the World Nuclear Association, Namibia's uranium mines have the potential to supply up to 10% of global demand for nuclear fuel. Drilling is resumed at the same offshore oil field in Benin after a 27-year hiatus led by Singapore-based Akraki Petroleum. The project marks a revival for the site, which was last active in 1998, having previously yielded approximately 22 million barrels of oil. This initiative has implications for reducing Benin's oil imports dependency, attracting investment, and enhancing its regional economic standing. The move marks a significant revival for a site first discovered in 1969 and last active in 1998, when operation ceased due to low oil prices and excessive water production. If successful, the phased redevelopment could re-establish Benin as a modest upstream player in the Gulf of Guinea, while underscoring the growing role of Asian energy companies in breathing new life into the West Africa's legacy oil asset. We'll go on a break, and when we return, we'll look at the top 10 African countries with the least recovery in GDP from the COVID-19 year to 2025. Stay tuned. Thank you so much for staying with us, and now to the rest of the stories. As the world pulls away from the height of the COVID-19 pandemic, the economic wounds inflicted on many African countries remain visible, particularly in countries whose real GDP growth has been slow or flat since 2020. While some African economies have recovered well, others have struggled due to debt, inflation, political instability, and overdependence on a small number of businesses. For countries that have failed to restore economic momentum, the penalty is not only economic, but also social and developmental. However, countries with chronically low real GDP growth are perceived as dangerous and incapable of producing returns on investment. This impression makes it more difficult to attract foreign direct investment, FDI, issue bonds at attractive rate, or obtain long-term finance for development initiative. With that said, here are the top 10 African countries with the highest leap in GDP growth rate in 2025. Top on the list is Ethiopia with the GDP rate as of 2020 was at 6.1%, and the current GDP at Ethiopia is at 6.6% with a difference of 0.5%. Second is Sao Tome and Principe. The real GDP as of 2020 was at 2.6%, and the current GDP rate is at 3.1%, a difference of 0.5%. We go now to Equatorial Guinea. Fourth is Tanzania. Fifth is Burundi. Sixth is Central African Republic. The real GDP as of 2020 was at 1.0%, and the real GDP as of this year is at 2.9%, a difference of 1.9%. We go now to Chad, with the real GDP percent as 2020 as a negative 0.4%. The current GDP rate is at 1.7%, a difference of 2.1%. We head now to South Sudan, where the real GDP percentage as at 2020 was at negative 6.5%, I beg your pardon, and the real GDP of as at this year is at negative 4.3%, a difference of 2.2%. We go now to Burkina Faso, with the real GDP percentage as at 2020 was at 2.0%. The real GDP this year is at 4.3%, a difference of 2.3%. And last is Guinea, with the real GDP percent as at 2020 was at 4.7%. The real GDP this year is at 7.1% with a difference of 2.4%. Angola retrieved $200 million in May from collateral it had posted earlier this year to JP Morgan following a rebound in the price of its sovereign bonds, according to the country's finance ministry. The repayment came after a sharp sell off in April triggered a margin call under a $1 billion total return swap agreement between Angola and JP Morgan signed in December. The one-year derivative deal was backed by $1.9 billion in newly issued Eurobonds, which did not raise fresh cash for the government but served as collateral. As oil prices tumbled amid global tariff tensions, the value of Angola's bonds, quoted at 100% on the dollar in March, fell to 86 cents, prompting JP Morgan's to demand additional security. Let's look at the US dollars against other African countries' currency. The US dollars against Nigerian naira is at 1,536.500, an appreciative point of 1.930, percentage of 0.13, with a weekly percentage also at 0.64. The US dollars against South African rand is at 17.662, at the appreciative point of 0.062, a percentage of negative 0.37. The US dollars against Zambian kwacha is at 23.0800, at the appreciative point of 0.3980, a percentage of a negative 0.70. The US dollars against Egyptian pound is at 48.4200, at the appreciative point of 0.0, percentage of a negative 0.14, with a weekly difference of a negative 0.02%. The US dollars against Algerian dinar is at 129.984, a low depreciative point of 0.049, a percentage of a negative 0.04, with a weekly difference of a negative 0.28. Niger's military government has nationalized the SML gold mine, citing strategic interest, and resource control. Military leader General Abdurrahmane Tiani, who took over power after a military coup, boosted former President Mohamed Bazoum in an overnight operation, announced the move. The government accuses the Australian operator of breaches, including failure to meet investment commitment. Similar state interventions efforts have occurred in countries like Mali, Guinea and Burkina Faso to secure greater local benefit from mining operations. South Africa will present a revised trade deal proposal to Washington, aiming to reduce the 30% trade that U.S. President Donald Trump imposed on its export last week. The proposal responds to the points raised on a U.S. trade report and includes significant concessions. South Africa has been in talks with the U.S. for months, offering to purchase American liquefied natural gas and pledging $3.3 billion in investment in U.S. industries to avert the tariff hike. However, those proposals fell short. Gold production in South Africa rose 3.1% year-on-year in June 2025, marking the second consecutive monthly increase and accelerating from a 1.5% rise in the previous month. The uptick contributed a positive 0.4 percentage point to the overall year-on-year growth in total mining output. However, on a seasonally adjusted basis, gold output declined 2.5% in June, following a 0.2% drop in May. Lastly, in African economy, South Africa's unemployment rate rose further to 33.2% in the second quarter of 2025 from 32.9% in the first quarter and slightly above market's estimate of 33%. It was the highest jobless rate since the second quarter of 2024, as the number of unemployed individuals increased by 140,000 to a one-year high of 8.4 million, while employed rose by 19,000 to 16.8 million. This resulted in an increase of 159,000 in the labor force. The expanded definition of unemployment, which includes those discouraged from seeking work, eased to 42.9% in the second quarter from 43.1% in the first quarter. The number of persons employed in the informal sector increased by 34,000, while employment in the formal sector declined by 19,000. The largest job gains were recorded in trade, private household and construction, while employment declined in community and social services. Agriculture at a negative 24,000, finance at a negative 24,000, transport at a negative 15,000, utilities at a negative 6,000, and manufacturing at a negative 5,000. The youth unemployment rate remained steady at 46.1%. And that brings us to today's edition of African Economy. Thank you so much for watching. I am Wang Fon Water. See you soon.